Hello and welcome to the Accredited Investors Only podcast presented by Accredited Life. I am your host, Peter Neill. Thank you so much for joining me today. I am very excited about the episode we have for you today. We have an amazing interview lined up with Sean O'Dowd from Scholastic Capital. So Sean does something that I like very much, single family rentals. And he does has a very unique investment strategy, maybe something a little bit different than what you've heard before, where he's buying single-family rentals in the best school districts, best areas that he can. He's holding them for the long haul, and he has a very unique way of finding these properties, analyzing the school districts in the areas and things like that. And he has a fund opportunity for accredited investors. So we're going to talk to Sean today about what he's doing. We're going to hear about his interesting story and kind of the foundation that laid he laid to where he got to today when it comes to why he does what he does with single family rentals and his very unique perspective growing up and moving around a lot of times. So we're going to get into that, and we're going to talk about what he loves to do and kind of the team that he's built around it. So without further ado, let's welcome Sean O'Dowd from Scholastic Capital to the show.
You're listening to the Accredited Investors Only podcast presented by Accredited Life.
All right, Sean, welcome to the show. How you feeling today?
I'm feeling great. Thanks for having me.
Awesome. So tell the listeners a little bit about yourself, Sean, and your company, what you do, and introduce yourself in your own words.
Yeah, for sure. So I'm Sean, located out in the Chicago suburbs, married, 2 kids, third on the way, and I run a real estate fund. We're pretty niche, and that's what we're excited about it about. But we buy single family homes in high-end school districts, and then we do long-term leases for the tenants who are moving into these homes. It's, we think, a really interesting market with a lot of supply demand dynamics that make a lot of sense for us. So it's been a lot of fun doing that. And then when I'm not doing the fund, I'm with the family.
Awesome. So a lot to unpack there. I'm a big liker of single family homes, especially right now because of supply and demand, that kind of thing. And like you said, you have a very interesting niche in the space with going after higher end school districts and things like that. So before we dive into that, what's your background? How did you get into the single family space?
Yeah, so the background, it was interesting. So I am originally from the Chicago area. I moved 22 times before I went to college.
Wow.
So yeah, so
What's the story there?
Everyone was always asked and hopes for something cool, but the reality is my dad's a sales rep, so different territories, kind of all over the country, and had a lot of kind of interesting downstream benefits. One of them was, I was the new kid at school every single year, which was a lot of fun because I just got to meet a lot of different people. The real estate element to it, though, was just by moving every single year, I just naturally got pretty interested. It's like, finding a house is like this annual fun game that we do. Like, where are we going to live? And coupled to that was my mom was actually a teacher. So she was starting and working in different schools. So we were bouncing around. And probably 10, 13, 14 years old, my mom and I both recognized, like, hey, like, no matter where we go in the country, there is a very strong pattern of there's always a really good school in that area. And everybody knows that school district. That is the best school district around. Everybody wants to live there. Everybody wants their kids to go to that school. Okay, we moved to a different, that was in New Jersey. Now the next year we moved to Wisconsin, and there's another really good school district there. It's like, all right, now we're in Illinois. There's another really good school district. Now we're in Boston, really good school district. It was just this universal pattern that kept coming up, and it started hitting me like a ton of bricks. Like, hey, like, this is a pretty universal thing where school district drives decision making for a lot of families.
Yeah, no, it definitely does, right? So that's a very interesting story, that kind of the foundation was laid at a very early age, and you definitely saw things from a different perspective than probably a lot of people who, if somebody like myself who grew up in the, same house and for the most part, for my entire, childhood and all, and really only experienced one school district, and I can remember like playing CYO basketball and things like that, and going to all these different schools, and traveling through baseball and sports and all, like, just that was how different things are, and you probably saw that from a totally different perspective in different states and that kind of thing. So what so that interesting foundation there. So tell me about the business and kind of your vision, and where you guys are today and where you want to be next week, that kind of thing.
Yeah, for sure. So fast forwarding a couple of years after moving around so much, went to school, worked in consulting for a while, and started buying these homes with my own money. Of like, hey, like, I think there's something here. If we buy a home in a really good school district that also is supply constrained, meaning there's no more land left, every lot's already got a house on it, and you're in a situation with a high owner occupancy rate, median in the country is in mid 60s, if we're in like the 80s, 90s, you can buy a house and you're basically the only rental game in town. So I bought a couple of those with my own money. Those performed really well. And I started getting investors kind of reaching out of say, hey, what you're doing here makes sense. I've moved for my kids' benefit or plan to do so. Like, I can see why there's a thesis around this. Can I invest with you? So about 2 years ago, we turned it into a fund model. About 4 months ago, actually. So we're relatively new. We brought in outside capital. We're up to about 11 million of homes right now. That's 21 houses, and we're buying at a pace about 4 to 5 homes a month. And the goal is to get this portfolio up to approximately 250 million worth of equity, which should be around 500 homes. And we have a lot of optionality at that point with whether or not we want to keep the portfolio and continue to send out our monthly distributions to investors, or if that's something that we instead want to try to sell as a portfolio to a larger institution. That 250 million worth of equity point gives us the optionality to go either path, and that's really the path that we're heading on. Is how do we get up to that inflection point where we then have the ability to make a decision that's best for the LPs.
So kind of paint a mental picture for me on what one of these homes will look like, because I think a lot of times people in single family rental world will gravitate more towards the low to moderate income type housing. There's more. You can make a property cash flow that way. You know what I mean? So what is it like? Are you buying homes? Do they need work? What's the renovation look like? All that kind of stuff. Just kind of paint a mental image for me of what your ideal home looks like, and kind of the story around it.
For sure. So there's a lot of different things that we look for the ideal home, but kind of rolling up to what we're at right now, our average purchase price is $479,000 right now. We're averaging 3.1 beds, 2.2 baths, 1,760 square feet. So 3 bed, 2 bath, 1,700 square feet is kind of bread and butter for us. These are homes where we're not doing much work to them, if any, and they are in pretty good shape. And we can talk a lot about the exact buy box that we're looking for. Right now, we're renting them for about $3,600 a month on average. Our average tenant makes about $205,000 a year right now. So it's a nice home. It's called entry level nice home in a great area with a high end tenant that is looking to rent.
And kind of so at 487,000 property value, right? That's what you said, or that's your cost?
That's what we're purchasing it for. Yep.
Okay. And then the value typically in that ballpark, I'm assuming, or because like you said, you're not really going in and doing a heavy renovation or anything like that. Kind of move in.
We're not going in and doing heavy renovation. So we have a lot of accountants for the firm. The accountants just marked up the fund. We're up 7.36%. So there is value now as roughly $520,000 for the homes.
Gotcha. So kind of give me an idea of the school district and that kind of thing. So what are you looking for? And then two, maybe before you answer that, like what areas are you investing in? Because I'm thinking in the Philadelphia suburbs, some of the really good school districts. I know my brother's been looking for a house for the last 2 years. You're not buying a house for under $750,000. You know what I mean? And even that's a fixer upper. You know what I mean? So give me an idea of the areas you're investing in, and then what do you look for in the area, in the school district, that kind of thing.
Yeah, for sure. So from an area perspective, like from a zip code perspective, we are looking for really high-end school districts that are supply constrained. So how do we decide which one's a really high-end school district? There's a lot of data to that. Like we have to use, for example, like the great school scores. Those are the ones that you see on Zillow because those are the ones on Zillow. So when people are looking for rentals, they see those numbers.
Sure.
But we're also looking at more data than just that. Our actually most predictive data set that we found is we have a data set that shows what percent of the graduates of the high school go to an Ivy League school or equivalent. And there's like a tipping point in that data where if it's above a certain percentage, the rent spikes for what you can get in that zip code. So that's extremely useful for us to see like what school has a lot of desire, a lot of demand for the parent from parents. That's our demand driver. On the supply side, we're looking for areas that are owner occupied about 90% or higher, meaning 90% of the homes in the area have somebody who is the owner who's living in them. And then we're looking for areas that don't have buildable land left, and then areas that have limited multifamily. So that's our supply side. So we want that to be as low as possible. So that's kind of our first step. We are explicitly upper Midwest right now. So Wisconsin, Illinois, Indiana, Michigan, and Minnesota. And across those 5 states, we only have 37 zip codes that we think our thesis works in. So it's a pretty tight area. I mean, I can give you an example. If you've seen Home Alone, the Home Alone town is one of the areas in which we're buying homes in. So it's a pretty high-end area. With a lot of people who are trying to get into that school district. And then once we were actually within the school district, there's a lot that we're looking for, like which house and why, but that's the area kind of funnel of how we get down to the exact spots we want to buy.
Yeah. That's definitely a beautiful home that Macaulay Culkin's living in, and in that movie. Very privileged area, very, very beautiful. That's a Chicago suburb, right?
It is, yeah.
Okay. Interesting. So talk to me about management, leasing, all that kind of stuff. Are you doing that stuff in house? You working with local experts? What's that look like?
Yeah, so we do have a third-party property management company, awesome partner. They are the in-house management arm to a single-family fund that's got about 2,000 houses. So they're called a decade ahead of where we are, but they're great as a property management partner because unlike most property management, they actually think from the owner's perspective because the vast majority of homes they manage, they actually own themselves. So it makes them easy to work with, and it makes we really care about data collection. They care about it as well because it's in their best interest as an owner. So we get along pretty well as a result.
And they do the leasing and like it sounds, and I think you may have said it earlier, I read it online, you guys look for longer term leases. Like what's your typical lease look like?
Yep. So they do the leasing. Our average lease right now is 26 months on initiation. So what is that? 2 years, 2 months. And we are intentionally looking for those longer term leases. Part of that is because there's a lot of demand for it from the tenant side, because most of our tenants are moving in when their eldest child is about to start high school. They're kind of like upgrading school districts or a good high school so that you can go to a good college. But because of that, the tenant tends to know they're going to be in that home for at least 4 years. Or if there's multiple kids, say 6 years, 7 years. So they tend to do longer lease chunks, 2 years at a time, 3 years at a time. So yeah, they tend, our property management partner handles the whole leasing process for us, with an emphasis of trying to get those longer leases for us.
Are you building bumps into the leases, or how does that work?
We do. So we do have escalators built into the lease. At 12 months and a day, there's a jump up.
Okay. Interesting. So kind of talk to me about what it is that you love to do about your job and the fund here. What do you find to be a fun thing that helps you to get up in the morning?
Good question. Well, so I mean, we're sending out our first distribution to investors in 11 days, and like I'm extremely excited about that. we're 4 months in. We had 45 LPs who took a shot on us in the beginning, and I'm excited to like literally pay back their trust in us. Like that's super exciting, and I'm excited about that. The running a fund itself is like there's a lot to do, and our team is growing quickly. But the thing that I like the best, and I think that I'm best at, is the actual decision making about which assets to buy. Just because that's moving so much growing up, I've been in a lot of homes, and I think I have just a lot of reps built out of hey, like what is a good house and why, and how does that differ around the country. So there'll be a lot of people joining our team who do different aspects of it, and more stuff will kind of come off my plate as our team grows. But the actual asset decision making is going to be something that'll always be on my shoulders.
Yeah. So how does it work on the acquisition side of the business? Because I think about what we do in workforce and affordable housing, where we tend to buy, dilapidated, distressed homes where we're not typically competing with regular mom and pop home buyers. The average person is not going to go in and put $100,000 worth of renovation. But for what you're buying, like a turnkey type thing, I would think, that's something that, is going to have interest from not just investors, but regular homeowners too, that kind of thing. So are you finding deals primarily on market? Do you have off-market resources? It kind of give me an idea of your acquisition side.
Yeah, so we do on market right now. We're about to start off market next summer. But on market is, to your point, we're competing almost always in multi-offer situations, and it's almost always against primary home buyers. So where we win deals is speed. So we built custom software in-house where it's hooked up to the MLS, and every time a new home hits the market, it gets spit into our data set. And that's about 2,000 homes per day when we're in like peak summer market. Sure. And we automatically filter out about 90% of them immediately. And there's a whole host of things that we're filtering out. For example, if it's a 2-bedroom house, we're not going to buy it. If it's only one bathroom, we're not going to buy it. If there's a pool, we're not going to buy it. If there's solar panels, we're not going to buy it. If it's on a street where the speed limit is faster than 25 miles an hour, we're not going to buy it. So there's about 16, 17 different things that are like automatically cut it out. So that gets us down to somewhere in the neighborhood of, it depends on the day, 40 to 60 homes. So we do a manual underwriting on. And then we do financial underwriting on, and all said and done, we typically have 5 to 10 homes in any given day that we like, where we like the price, where we think things make sense, and we can get an offer in on that home typically within about an hour of the home hitting the market, and that gives us a huge speed advantage. Because then, for example, we bought a home this year, bought it for $460. We got the offer out in about 30 minutes, and they accepted our offer. They got 2 offers in the 490s. Now, our offer was fast. Our offer was high likelihood to close because it was a heavy cash buyer compared to primary home residence buyer who may or may not be approved on the mortgage. But like theoretically, there was $30,000 worth of equity gained because we were able to move pretty fast and getting those offers out.
Sure. All right. Now, are you typically buying with cash and putting financing in place down the line, or kind of talk to me about that?
We've got both. We prefer to do cash. We have done mortgages in the past. We prefer to do cash just because it makes things a little bit easier on the closing side.
Will you put long-term financing in place once you've closed, or?
We do. So right now, the entire portfolio is on 30-year fixed debt, and that's 30-year term debt too. We don't have any balloons. We don't have any floats. We think SFR is a kind of a defensive asset class in general. Like people put money into SFR for like wealth preservation rather than wealth generation typically. So we want to use the most stable debt possible.
Yeah, I know. I think when you look at the financing that you can get in SFR, versus what you can get on the commercial side, I think it's a way of banks telling you what they think is safer in some way. You know what I mean? And so I think that's something that a lot of investors don't realize. Like they don't think about how advantageous the debt situation is in SFR versus commercial, and why it is that way. LTV, what's that normally look like? Is it 70%? Is it 80? Is it 60?
we're 59.1% of the portfolio right now, and we're going in typically 65%, although we can go 65 is the absolute max. So we typically go in anywhere between 50 to 65, 59% is our weighted average right now.
So, big question in the space right now has been insurance and taxes and kind of those costs going up. Like you said, you have bumps built into your leases now. What have you guys experienced? What do you think's coming down the line? I don't know your markets as well as I know mine, obviously. So, give the listener some idea what those markets look like and any of those kind of external forces, that are putting pressure in those markets.
So I am a very firm believer that the biggest story in real estate over the next decade, if we're having this conversation in 2034, the biggest story is insurance. It's going to be the thing that everybody's talking about, and it is going to be the reason deals pencil or don't pencil. So we're intentionally buying in the upper Midwest. The reason why we're doing that there's a couple reasons, but the primary one is insurance driven. So going back to where do we want to take this portfolio? We are building a portfolio that we could sell, and sell for top dollar for our investors. So when we started buying, or before we even started buying, we spent a lot of time with some of the largest single family institutions out there, the guys who own 10, 20, 30, 40, 80,000 homes. And we said, hey, if we build this portfolio and try to sell it to you in the year 2034, where you can be most excited to buy it, the unanimous answer we got back from all of the funds was upper Midwest. Because they're like, I can't, we have a quote in our deck that says this, but there's a guy in a major fund who's like, I don't think we can profitably own SFR in Florida and Texas 10 years from now.
Yeah.
So if we need to buy houses and we can't buy houses in those states, we just have to move further north.
Yeah. That makes a lot of sense. So how did you have those conversations? How did they go? How was the door opened, and how was that received? All that kind of stuff. Because I think I talk about that with our funds. I think that's another exciting opportunity for an exit in the SFR space if you get your portfolio up, large enough. And I've seen a lot of SFR funds where that is their goal, is they want to build a portfolio, because you're not seeing those large institutions going out buying up scattered site like they were maybe 10 plus years ago, and when they were buying a lot of mortgages and things like that. Now they're focusing more on the BTR space, buying those huge tracts of land and stuff like that. With what you're talking about, this is a little bit more of a one-off game, in the built environment and those kinds of places. So you're providing a value to them that that's not what they do. You know what I mean? So I could see that being very attractive. How are you able to open those doors and have those conversations?
Yeah, honestly, it was a lot of doing research on LinkedIn of, hey, this is the list of the 10 funds that I need to speak to, and I need to talk with somebody who's a decision maker at those places. I can't talk with somebody junior. So how can I find somebody where I know somebody who I know somebody who I know somebody who can get me in the front door? Or if I don't have that, how can I send an email to somebody where they'll be interested and hop on the phone? And it was actually a lot easier than expected. And I think the reason why is it's in those funds' best interest to talk to us, because to your point, we are an aggregator for them. It is in their best interest for us to be assembling a portfolio that they would want themselves. For example, one of those funds will not buy a house with solar panels. Doesn't matter, go to the deal list. If there's solar panels on it, they don't want the house. So okay, if we built a portfolio of 500 houses, but 300 of them have solar panels on them, they're going to be like, we don't want this portfolio. Sure not. So they were pretty forthcoming about what they're looking for, because they want to look at the portfolio and be like, yes, this is exactly what we wanted. How can we make this a more interesting transaction and get this done?
Yeah. Do you know what their thought was behind that? I've heard people say that, especially for fire purposes and things like that. They can't go in and do certain things. When you have solar panels up. Or what was the thought process behind that?
There's a bunch of issues. One of the biggest ones is solar leases. Most panels are leased, and they tend to be very predatory. And if you put an institutional individuals inheriting a predatory lease, the holder of that lease is going to go after the institution, because the institution's got the money to pay, and it's just not going to be a good situation for them. Other issues are insurance related, harder to insure the roof less, shorter lifespan. So there's stories of funds buying homes with panels in the past and ripping the panels off.
Sure.
And now they just want to buy without panels at this point.
Yeah, no, that's very interesting. Cool. Well, it's you got me thinking here. I mean, I think this is a very interesting strategy. So where do you how do you, talking about like the institutional type exit and all, I think so many people think of evaluate single family from a one-off home perspective, right? I mean, what is this home valued based on comps? I'm assuming you guys are also looking at an income approach as well. Talk to me about how you kind of the different ways you approach evaluating your portfolio, and kind of give me some thought about that.
Yeah, so there's a couple of different ways that we're doing it. The first is when we're actually buying the home, where we're looking at like what do we need to pay to buy this home to get in at our underwriting goals, which is 6.5 unlevered cost and yield, and is that close to what the mom and pop homeowner who's selling the home is looking to sell the home for? Once we actually own the home, we have because we bring in investors at any point, like we need to revalue the portfolio. So our accountants get third-party valuations from an appraisal company on a quarterly basis to value what the home is at. And then we look at it on a cap rate from what a sale would look like. And it's interesting because the SFR portfolio cap rate can dramatically change depending on where we are in the economy. So if we were a couple of years ago, you had a good portfolio, like really good portfolio, you could get something in the 5.0 to 4.75 range. Today, that same portfolio might be like high fives, low sixes. And that's why we want the 30-year fixed debt, because there's a huge kind of cyclicality to the SFR space. If you try to sell at a specific point in time, like you might be in a rough spot. If you're trying to sell at a great point in time, like you might be able to get a substantially better cap rate. So to your question on valuation, like we're keeping an eye on what the portfolio will be worth from a cap rate perspective. I don't think we sell unless we get a cap rate that's going to be 5.0. Otherwise, we're going to keep the portfolio and send out distributions to our investors each month.
Yeah. That's amazing. So, wow. Well, this has been a really great conversation. Anytime I go on podcasts, people ask me this question. Maybe I'll throw it over to you. Anything that I didn't ask you that you think is important for the listener to know when it comes to, what it is you guys do, and just why you think this is something that people should be taking seriously? And I say it all the time, I think with everything going on in commercial, I still like commercial. I like multifamily, I like warehouses, industrial. There's a lot of things I like about certain other asset classes, but I really think there's a time and a place for single family, and especially right now with supply and demand. It actually, something that just came to mind was, what's your thoughts on the kind of the political, arena when it comes to SFR, that kind of thing? Do you think a lot of things have been said, I think a lot of things for political purposes, they sound good, but in practicality, they don't make a whole lot of sense. I mean, what's your take on that, and how do you factor that in? Because it sounds like you guys really do take a long-term approach to this portfolio.
We do have a long-term approach, and there's definitely risk from a regulation perspective. It's something we're watching, but it's also something we can't control. So it's hard to fully underwrite it the right way. The most recent legislation that was proposed, our attorneys looked at it and said there were loopholes we could drive a truck through from a science perspective. But we also don't know what, if legislation will be passed, and if it does get passed, what it would look like. So for now, like, we're going to continue with the business model as is. And if things change because something else comes down the line, like, we'll look at what that looks like, and we'll collectively make a decision with the LPs on what's the best way to steward their capital.
So this is the Accredited Investors Only podcast. I'm assuming your funds are open, only to accredited investors. Give me an idea. Like, you're not accepting capital right now, it sounds like, or you are, or you are?
We are. We can technically bring in capital at any point. So we are fundraising technically constantly.
Okay, so yeah, we're the same way. I mean, because I think with SFR, with the smaller buy-in, and as long as you have, if there's product in the market, like you said, you guys are saying, 10, 15 houses a month that you like, that fits your buy box, you got to keep raising, right? So talk to me as much as you can about like the structure of the fund, how it works, splits and things like that.
Yeah, for sure. So we're a true fund model. So we true fund model, and we're
Well, explain to the listener what that means.
for sure. So it, and I'm not an expert on this, but my understanding is that there's kind of two different ways that you can do investing as an LP. One is you go deal by deal, where you put capital in and you own, let's say, a 10% interest of 123 Main Street, and you own your interest. You get distributions from that. You get your equity at the end of the sale. We're different in that we're a fund. So when an investor buys into the fund, they own a piece of all of the homes that we have already purchased, and they own a piece of all the homes that we will purchase. So it's kind of an interesting difference because they know they're going to own, call it 10% of 123 Main Street and 745 Apple Tree, and they get to see the homes that they are buying into. And then we'll take their capital, and because we're seeing homes all the time, we'll go buy a new house with it and then keep adding more and more homes into the fund itself. And then to your point on terms, like we're super simple, straightforward. It's an 8% preferred return, meaning the investor gets every dollar the fund makes until they get 8% on their money. And then after that, the investor gets 80 cents on the dollar, and then we get 20 cents on the dollar. We have a 1.5% management fee. And then there's no other fees on top of that, no acquisition fees or disposition fees or refinancing fees or some of the other stuff you sometimes see added on.
Sure. And it's an evergreen structure, it sounds like. This kind of can go on in perpetuity.
Correct. That's right.
Awesome. So how would listeners find out more about you and the fund, Sean?
Yeah, for sure. So scholasticcapital.com is our website. We've got a bunch of really good stuff there. We share all of our updates with our investors first, but we do share a sanitized version of those updates to the general public after the investors have gotten it a couple weeks later. So you're feel free to sign up and kind of check out and see what our updates look like as they come out. And we're excited to keep kind of sharing what we do. I'm pretty active on Twitter, sharing kind of a running stream of conscious about what I'm seeing on a day-to-day basis, what our team is working on a day-to-day basis, which tends to be really fun because then you can have a little bit more back and forth with folks, with people interested in asking questions.
Sure. That's awesome. Well, I really appreciate you coming on, and I really enjoy this conversation. This is different than what I do in the SFR space, and I think it provides a great diversification. I mean, I'd love to continue to have a conversation with you, and maybe we have a mastermind community that we run beyond this podcast. I'd love to have you come on and maybe talk to the group and take this conversation a little bit deeper. But I really appreciate you coming on, Sean, sharing about your background and the fun you put together here. And you have a very unique model that I think is very good and very timely for what's happening, and from a future standpoint, is a good place to be. So I really appreciate you coming on here, and look forward to staying in touch and seeing where things go.
Yeah, thanks for having me. It's always fun to talk real estate.
Awesome.